While we're in our mid-20s, we'll be looking for ways to attain financial independence. Our salary might not suffice, and we'll be looking for ways to earn a passive income. That is most probably how we'll come across the word stock trading. When you hear the word stock trading, the first thing that comes to your mind is quick and easy money. Let me get something straight. I am not an expert in stock trading, and just like most of us, I started off thinking that it's quick and easy money. And I started learning about it about 4 months ago. And I've been trading stocks actively for the past 3 months while learning about it as much as I can from all the courses, videos, blogs, and whatnot. So in this video, I'm going to talk about the science involved in stock trading, or at least what I found to be the scientific basis of stock trading from my experiences in the past 3 months. Now, this will not be very useful for people who've been actively trading stocks for the past years, but for beginners who are not very sure what to expect, this will surely help you shorten your learning curve. I'll be talking more about equities because I haven't started learning about derivatives yet. But I think the principle involved is more or less the same and will be useful anyway. Most of us might have heard that stock trading is like gambling. That's actually true. Stock trading is a lot like gambling. Now, this is because the stock market is a chaotic system with too many variables influencing the state of the system at the next moment. It's very much like the weather. Just like no one can predict the weather with 100% accuracy, absolutely no one on the entire planet can predict the price of a stock at the next moment with 100% accuracy. So how is it that we see people make money out of this consistently? We know people who make a living out of trading stocks. If it were a complete gamble, this would not have been possible. So there is some scientific principle involved. Now let's understand it. Stock trading is just like any other business. You buy a commodity at a particular price and then sell it at a higher price to make a profit. Here the commodity involved is the stock of a publicly listed company. The prices of stocks go up and down depending upon supply and demand. I think most of you might know all of this. Now, what we're trying to do is buy a stock at a lower price and then sell it at a higher price. Or you could sell a stock first at a higher price and then buy it later at a lower price. Now, for the sake of understanding, we'll only be talking about the first case here. So we're all looking to make money, and for that, we'll need to buy the stock, the price of which will surely go up. But the problem is, as we've discussed earlier, no one can accurately predict the stock prices. So before we discuss the solution to our problem, we'll need to understand a few terms. Now, when you buy a stock and you sell it, we'll call it a trade. Now, suppose you buy a stock at 100 rupees and you intend to sell it at 110 rupees. 110 will be your target. So target is the price at which you intend to sell the stock once the price of the stock has gone up and you've made your profit. Now, suppose things don't go as planned and the price of the stock moves down after you've bought it. In order to prevent a heavy loss, you place something called the stop loss order. Just as the name implies, it is meant to stop loss. So what you're doing here is you're selling the stock at a loss, even in order to prevent a heavy loss, in order to prevent further loss. There is a rule followed by almost every trader. The target to stop loss ratio is always maintained at 2:1. So suppose you're buying a stock at rupees 100, your target, and if your target is 110 rupees, your stop loss will be 95. So here the target is 10, greater than the price at which you've bought the stock, and your stop loss is 5 lesser than the last traded price, that is the price at which you've bought the stock. From here on, for the sake of understanding, we'll be defining probabilities out of 10. So when you place 10 blind bets, you'll be winning 5 and losing the other 5. And since we've already set the target to stop loss at 2:1 ratio, when you win 5 of those bets, you'll be gaining 10 units. That'll be 10 rupees. And when you lose, you'll only be losing 5. So you will be making a net profit of 5 units, maybe 5 rupees out of blind trades. But in the ideal setting, this is not what actually happens. Since the stop loss is twice as close to the buying price as compared to the target, and since stock movements are completely erratic and random, the probability that the stock price goes and hits the stop loss will be twice as much compared to it going and hitting the target. So for a blind trade in which the target to stop loss has been set at 2:1 ratio, the chances of a win when expressed in terms of probability out of 10 will only be 3 out of 10. And if you can calculate the outcome, 3 wins against 7 losses will put you at a loss. So this is not a very good odd for someone who's betting their money on this. And it's for this purpose we have what we call technical indicators. These are tools that have been devised using statistical data to improve your odds of success from 3 out of 10 to maybe 6 or 7 or 8 out of 10. Now, a very important thing that beginners don't understand is that you never focus on the outcome of a single trade. From what we've learned so far, we know that winning just 5 out of 10 trades can give you a decent profit. So instead of focusing on the outcome of a single trade, what you do is you create a trading system that will be a collection of trades over a week or a month, and you'll be trying to win maybe 60 or 70% of those trades. We've devised a strategy where we fix the target to stop loss at a 2:1 ratio and use technical indicators to win 60 to 70% of our trades. Now, what most beginners do is they, rather than trying to create a trading system or trading strategy, they try to win each and every single trade. And when you try to win each and every single trade, you'll not be able to stick to your strategy. Something that I did myself was when I saw the prices go down and when it was about to hit the stop loss, I would take the stop loss much lower, and eventually I would end up making a much heavier loss. And understand this, in order to make a good trading strategy, you'll need to be able to handle loss. You have to accept the fact that taking a loss, an occasional loss, is a part of your trading strategy. Now, another very important thing before you dive into trading is never to have unrealistic expectations. In the history of trading, the man to make the highest percentage returns on his investment is Jim Simmons. He used to trade with advanced algorithms and supercomputers, and his returns per year, per annum, was about 66% on his investment. So never expect to double or triple your money within a year. Always have in mind a return of about 50% per annum, and you'll do very good for yourself. I hope this video was useful for you. If you haven't subscribed to the channel yet, please do subscribe. We'll be coming back with more interesting videos on more interesting topics. See you all in the next video. Thank you for watching.